What I would, I mean, nothing sells like fear. So what I would predict is as the economy starts to slow whenever that happens, and as there's more of that conversation, they will be beating the drum, the fear drum. And it's up to us as mortgage and real estate professionals to be the trusted advisor, and as Will so eloquently said, give them the wisdom behind the numbers. And that's really what I aim to do today. So before you leave today, here's the three things that I want to make sure that you have. First of all, you're going to know why so many are predicting a recession coming. And you're going to know why this recession is likely to be very different from the last recession, the Great Recession. And you're going to have some data points on that. You're going to have a copy of this slide. Ryan's going to email you a link to an article that I wrote that is basically this entire presentation in an article form. You're welcome to take those pictures, that article, copy and paste, put it in your social media, put it in your blogs, put it in your newsletter. However you want to reuse this to repurpose this content, you're welcome to do that. And of course, you've got the handouts in case I have failure with the slides. And hopefully you're going to feel, my ultimate goal is that you are really uber comfortable with having a conversation with a client who says, I'm not sure now's the right time. I think there's going to be an economic recession, or I think the market's at its top, there's going to be another pullback, and I'm going to pause till that happens. Has anybody had anybody say something similar to them like that? Okay, so my goal is that when somebody says that, you feel 100% comfortable saying, well, let's talk about that, and let me send you some data points on that, and let's go a little deeper, because I'd like to challenge that assumption with maybe more data than you currently have, right? Because if we just hear the news clip on the newsreel, it's just fear. But let's see if we can go deeper. All right, so 86% of economists and business experts are predicting a recession in the next 24 months, between now and 2021. That's a lot, right? And I think it's important that we clear the definition of recession. A recession is simply 2 consecutive quarters of economic contraction. So instead of the economy growing, it starts to recede a little bit. A recession doesn't mean housing crisis. But since the last recession equaled a housing crisis, I think the majority of our clients, when they hear recession, they think, oh yeah, that's when I got foreclosed on for my house. Or for our younger generations, oh yeah, that's when my parents went through their divorce and had to sell the home out of bankruptcy, right? So very different, but I think we need to first make sure that clients understand the difference of that. So the question is, why are 86% of economists predicting a recession? And I'm going to give you a couple really important data points that I follow. The first is the inverted yield curve that I talked about. Did anybody hear some of this last week on the news? The inverted yield curve, and everybody's freaking out? All right. So let me just explain what that is really quickly. What you would normally expect when we talk about an inverted yield curve, we're talking about a bond. So let's talk about treasury bonds for right now. I loan the government money. The government's going to pay me back interest over that period of time. It could be a 1, 2, 5, 10, 30-year bond. And what you would expect is, if I'm going to give you money for 10 years, that you get to go, let's say you're the government, and I'm going to give you money for 10 years. Now you can go do whatever you want to do with that money. I would expect you to pay me more in interest than if I gave you money for 1 year. Does that make sense? Because if I give you money for 10 years, and at year 5 I have another opportunity, I can't get that money back. So I want a higher return for a longer period of time that my money's tied up. Super common sense, right? Just like a 30-year mortgage has a higher interest than a 15-year mortgage, right? That makes sense. Okay, so on a normal yield curve, the longer the maturity in years, the higher the yield or interest rate. If you're a borrower, you pay interest. If you're a lender, your rate of return is your yield. Does that make sense? So if I'm lending somebody money, I want more yield or more rate of return if you're going to tie me up for a longer period of time. That's a normal yield curve. An inverted yield curve is you yield more money or a higher rate of return for the short term, and the longer term is lower, a lower rate of return. So why would somebody tie their money up for 10 years at a lower rate of return than they could get in a 1-year treasury bill? Anybody have an idea?
Legal.
So The yield, yes, the yield is lower. But the question behind that is why? Why do yield curves get inverted?
Well, it has to do with the supply and demand aspect of the bond.
It does.
And people coming into the, like, foreign money, whatever, money's coming in, buying up those bonds over the long haul. And a lot of it can be the global economy.
Yes.
They don't have a better place to put it.
Very true.
And relative to return to risk factor.
Yes.
They don't have a better place to put it. They're going, you know what, I'm just going to sock it in the U.S.
Yep.
The bond. And
I've got a slide on that because that is a really interesting factor right now. But let me also have you noodle on this. If you're a bond investor and you make your living off of the interest on bonds, and you think the interest available on bonds is going to be lower in 2 or 3 years because we're going into a recession, then you might say, I'll take the 10-year yield now because I want to tie that rate of return up for 10 years because if I do a 2-year bond, in 2 years I get the money back and I think that's going to be, the yield's going to be lower. So what this is money managers saying, we think we're entering an economic slowdown. We want to tie our money up for as long as possible to weather this storm, and we're willing to take a lower yield because we don't want to have to worry about reinvesting this money in 2 years when maybe we think the interest rate's going to be 1%. Does that make sense? And you were exactly right that the reason in the last couple of weeks why are the yields so down on the Treasury is we're getting a ton of foreign money because there's negative yielding government securities in other countries. Yeah, so you're spot on. Okay, so let me tell you why this is important. This is a graph of the 10-year Treasury, that's a 10-year bond, minus the 2-year Treasury. And when the 2-year Treasury starts to pay a higher yield or rate of return than the 10-year Treasury, it's an excellent predictor of recessions. So this is the line. This is ground zero across here. As this goes inverted, that means the 2 years yielding greater than the 10-year. Here's an inversion, recession. Gray bars are recessions, by the way. Inversion, recession. Inversion, recession. Inversion, no recession. It's not 100% accurate. But inversion, recession, is that a pretty good indicator that if there's an inverted yield curve, you might have a recession ahead? Yeah.
But with an emphasis, that's only 2 quarters of downturn.
Very good point.
I mean, is it really a big deal? I mean, really, historically, is it that big of a deal?
That is the golden thread from this presentation that we need to take to our clients. And I'm going to give you some data to share on that. That's exactly my thesis.
Josh, the width of those gray bars is the length of the recession.
Oh, great point. Yeah, thank you. So mini recession, pretty good recession. Medium recession. 2001 was pretty painful.
Yeah.
That one was really painful.
Yeah.
But yes, that's the length of time. And I would say, therefore, the severity of the recession. Yeah, great point. Thank you. I'm just grateful we have gray bars. I gave this presentation in Park City, and I got to this point, and there were no bars, and there were 100 realtors in the room. And at that moment, I couldn't figure out what was wrong with my slide, but I couldn't read the slide. And I'm standing here, I'm like, wait, I've given this presentation a dozen times. Am I high? Like, what is wrong with me? And then I finally figured out there was no bars. So I'm like, how do I explain that chart with no bars? That's interesting. All right. So this is the U.S. Treasury yields as of yesterday. Okay. And what we should see is from left to right, low yields to high yields. And what you're starting to see is some inversion. 1-year Treasury paying me 1.72%. 2-year Treasury only paying 1.49. So why is it paying less, right? That's the inverted yield curve. 5-year Treasury, 1.42. So these people buying these bonds, the reason why these yields are low is because there's more buyers here, supply and demand. There's more buyers going into here that's driving this down. These people are saying, I think we have a recession in the next 5 years, but I bet it's over in 5 years. So I'm going to park my money here at 1.42, because if I think I take 1.72 this year, next year I might only get 1. So if next year I'm only going to get 1, I'm pretty happy with 1.42 for 5. You with me? And what hit the news last week that went Chernobyl everywhere was that the 10-year Treasury was lower than the 2-year Treasury. You can see they're only just, 1.49 to 1.56 but that went below the 2-year for just briefly, like one day, and that kind of rang the alarm bells. But as this trend continues, more of that, negative news drum beating is going to happen, okay? Let me give you one other economic point, a data point that predicts recessions that has never been wrong. I showed you on the inverted yield curve, there was that one false alert. This is 100% going back to 1950 when the data started to be collected. It's never given a false reading. It's 100% accurate that a recession is coming. Again, a recession, just 2 quarters of negative economic growth. All right, this is the civilian unemployment rate, okay? So you take the unemployment rate, and here's what I want you to see. As the unemployment rate bottoms and starts to go higher, recession. Bottoms, starts to go higher, recession. Bottoms, under 4% unemployment, great, economy's rocking. Unemployment rate starts to go up, recession. Bottoms, recession, 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 bottoms, recession. We're now down with the unemployment rate at 3.7%. So when you start to hear that the unemployment rate is at 3.7, 3.8, 3.9, 4%, that is the forming of the bottom. What that means is the unemployment rate is starting to go up, and that is a 100% indicator of recession. So it's good for those of us that have money in the stock market. Some of us might want to pay attention to that, that when that starts to go up, there's tightening that's going to happen. The economy is going to tighten. All right, so here gets to the point of what's the big deal about a recession, okay? And this is the last 5 economic recessions, 1980, 1981, 1991, 2001, and 1907. And relative to home values, in 3 of the last 5 recessions, home prices are up, not down, up. In 1991, that was only a 1.9% correction. I call that a wash, right? This is the outlier, right? So the question is, bless you. So the question that I have about this slide is, why does real estate do well in recessions? Why is that? You look at stocks during these periods of time. How did stocks do in 2001? They got hammered, right? Some of those companies have never recovered. Why is it that housing does so well? That's the first question I want to know. And the second question I want to know is, why was this recession different? And why is this the outlier, right? And I think that our clients, at least the clients that I talk to, have very little reality with these recessions. They don't remember what happened to real estate values back here. They're very acutely aware of what happened with real estate values in this. So we need to give them a little more perspective on how recessions impact housing, number one. And number two, why does housing respond that way? Relatively good, pretty darn good. I mean, I'll take that bet all the way up to that recession, right? Any day. All right, so why did this recession impact housing so differently? Well, this is the historical data for Mortgage Credit Availability Index. This is a report from the Mortgage Bankers Association. And basically, the Mortgage Bankers Association goes in and has created an index to communicate to us how hard or how easy it is to obtain a mortgage, right? And they're scoring that to say, hey, are underwriting standards loose or are they tight? Or is it very hard to get a mortgage? So right down here around 2004, this index started to skyrocket. That's by the way, that's when they started keeping data on this. And when the index goes higher, that means it's easier to get a loan. Somewhere around 800, which we accomplished in late 2005, early 2006, means that to get a mortgage, you either had to fog a mirror or have a pulse, but you didn't need both. You could just one will do.
Yeah. Wasn't that when the Community Reinvestment Act went into play? Isn't that what caused that?
I would say that was a major player of that. Are you guys familiar with what that is? Yeah. Almost like ubiquitous healthcare or ubiquitous college education. It was ubiquitous loans.
In other words, our politicians created that.
There was definitely legislation that forced Fannie and Freddie and banks to open up lending to places that their inner knowledge was saying that's probably not a good loan.
My point is, the people pointing the fingers at the banks are the people that caused the problem, not the other way around.
100%. That's exactly right. That is exactly right. So we get this wild, anybody can qualify for a loan up here. Bartenders buying 15 investment properties, not because they positive cash flow, but because, hey, by the time the home's done, it's going to be worth 20% more, and I can just, cash out with a home equity line or what have you. And the point of showing this slide is that this bubble in credit is what caused that crash. Okay? We have to correlate those two to our clients. We have to be able to show them your memory is that recession equals housing crash. It wasn't the recession. It was that. It was this no thought process on, can this person actually pay this loan back, right?
It's not false market is what you're saying.
Yeah, that's right. Right, because if everybody can qualify for 10 investment properties with no money down, very little credit, and very little income, and everybody's speculating at the same time, there's only so many houses that can be built, so we have inflation, right? We have higher prices, and that's what was driving that market, the false market. So what's very interesting is since 2008, this has not even gotten back up to 200, right? We all know self-employed clients need tax returns, borrowers need W-2s and paycheck stubs, got to show where that money came from, to a point of annoyance. But as annoying as that might be for some clients, it's really good for our housing market. It means that everybody in those houses can actually pay for those homes. It's not a fake market. It's not fake demand. That's the big difference. So here's what it's done in terms of performance. And I'm going to skip to this line. This is mortgage delinquency rates in 2018 versus 2019. You can see, and they're near all-time lows, by the way. You can see from 18 to 19, the 30-day lates are going down, the 120-day lates are going down, the foreclosures are going down. 0.4% of all homes in the United States are currently, that have mortgages, are currently in foreclosure. That's 1 in 400. That includes all the homes in the floods last year, all the homes in the wildfires in California last year. All of those homes, 1 in 400 homes are in foreclosure. Incredibly solid foundation underneath us. Why? Because it is work to qualify for a mortgage. You actually have to be able to pay the thing back, right? Very different market than what led into the years leading up to 2006. I love this slide. I think this might be the most powerful slide that we have. And again, the gray bars indicate times of economic recession. And the black line is housing appreciation according to S&P Case-Shiller U.S. National Home Price Index. So this is national across the country. And the red line is just kind of to smooth out the highs and the lows. But what you're going to see is going back to 1975, the Case-Shiller Home Price Index has appreciated at 5% over 50 years through 1, 2, 3, 4, 5, 6, through 6 recessions over 50 years, up 5%. And most of these recessions, values up, values up, values up. This one we took just a little jog, but then right back towards up, values up through this recession, right? This was the one that was down like 1.9% or something like that. But through virtually every recession, housing prices have gone up. So again, the question is why? Why? Why does housing go up? Because if you looked at the stock valuations through those recessionary periods, they got slaughtered. Gold probably did pretty good. Real assets probably did pretty good. All right, well, here's the secret. As we go into recessions, economic slowing, the Federal Reserve does what? Drops rates. Already has, right? We're already into this cycle, okay? So in 1980, you were selling real estate. Who was selling real estate in 1980? Were you? Were you?
I was investing.
You were investing, yeah.
2% interest rate.
And how did the 80-82 recessions feel? They were big recessions, right? Yeah. But look what happened to interest rates. Interest rates went from 16% to 11.75. It's a 25% reduction. That means even though we look at 11.75 and go, eek. But at that time, to a home buyer, if they were looking at a home and pricing out a property in 1979, and then priced out the same property in 1980, mortgage rate's down 25%. That means their payment's down 25%. That looks pretty good.
Absolutely.
Your $3,000 payment just went to $2,200. I'm in.
16%, the games they were playing, the
all-inclusive
all that kind of
trust
stuff.
deeds, and yeah.
It was crazy.
It was a crazy time. 18% to 3%, 11% to 8.75%, 7.3 to 6.75, 6 to 4.875. And if this were updated to live time, this would tell you we're not in a recession yet. But we can already see that interest rates peaked at around 5% in December last year. We're already down to the low 4s, high 3s, depending on credit score and how much you're putting down. So we're already down 20% in interest rates, right? What I would tell you about interest rates, by the way, before I go on to the next slide, is I think they're going lower. As we enter into the next economic recession, I think you'll see the lowest rates you've ever seen in a 30-year fixed. I think we'll see the 3%, 3.1, 3.2 on a 30-year fixed, lower than ever before. We already hit the lowest 30-year U.S. Treasury yield ever in the history of our country since the 30-year Treasury yield was available. We hit that last week. But I think the mortgage rate will make it to the lowest rate ever as well. And I think the people who got burnt out on shopping for homes, last year you showed that inventory, 10 days, wasn't that the average on inventory last year? So people got burned out. Interest rates went to 5%. They signed a lease. Fast forward till now we're pitching a 3.875 interest rate, and you've got a little more inventory. That's a great market. That's a great market to sell houses in. And I think you'll see that interest rate below 3.5 on the 30. Global government bonds, okay? So mortgage interest rates and treasury bonds are not the same market, but they move in a similar pattern, okay? And the reason why I say that interest rates will continue to go lower is the point that you brought up, Todd, that half of the developed world is negative yielding interest rates. I mean, think that through, right? You're in Switzerland. I give you $1 million for 10 years, you're going to give me $950,000 back. Deal, here you go. It's insanity, right? So how long does it take before the Swiss decide, I don't want to buy any more of those. I want to come over here, and this says 2. Last week it moved to 1.5, right? But how does 1.5 sound as compared to negative yielding? Sounds pretty good, yeah. So there's going to be more and more of this foreign money chasing yield, and that demand will further drive down interest rates in the U.S. All right, so I'm going to kind of bring this to a close, if you will. But I want to go back to something that Will said to open this up. I see a very clear divide in your business model, as I see in our business model as mortgage professionals. Like let's say this says Berkshire versus Homey. Let's say Fairway or Intercap compared to Quicken, okay? Homey and Quicken sell price. Go to their website, what do you see? So we save home sellers $10,000 average, list your home today. Go to Quicken, what does it say? 3.235 on your 15-year fixed. It's all about price. There's no advice. And what I would encourage you to think through is, how do we gather more information than the negative news on the media? How do we become the trusted advisor? And how do we lead our clients into this next recession feeling empowered to make a really good decision? I mean, it kind of makes my stomach churn to think that there's a young home buyer who got burnt out and couldn't find a home last year because of the inventory shortages, looked at payments at 5% and said, no, I'm just not comfortable with that payment. I'm going to pause. I'm going to rent. And now we're going to go into an opportunity with 3% interest rates and a little more inventory, and they're not going to pull the trigger because they're not getting advice. You with me? At Fairway, we kind of feel like that's our moral obligation to educate and to step into the light and be that trusted advisor, and I see that's the exact same value proposition that you guys bring. I'll leave you with this slide. This is the last slide. And if there was one slide that I would have, like a picture on my iPhone, when you're out with a client walking through a house and they go, I think I'm going to pause, I'd have that slide, and I'd say, let me show you how housing is done through the last 6 economic recessions. Okay, let's talk about it. Let's look at the real data. Because you know what I think you're thinking of? I think you're thinking of this. And going back to 1975, that's an anomaly. That's an anomaly, right? But if you just had a couple of these on your iPhone or your iPad, and you could just flip through a couple of those slides, I think you'd have a real powerful conversation. You could create a real powerful conversation around that. Any other questions about that, guys? All right. Thanks so much for having me. That was a lot of fun. Thanks, guys. Thanks, Phil. Thank you.